Morning, everyone, all the distinguished panel members who have joined from various locations, and also to all the participants from across the country. Uh, First of all, a warm welcome, and thank you very much for joining in this webinar on implementation of the budget announcement. So I welcome each and every member of the panel. Shri N.S. Vishwanathan ji, former Deputy Governor of Reserve Bank of India, and he brings in a vast experience in banking regulation, supervision, financial sector policy, and currently in his role as a leader or a strategic leadership for a Indian private sector bank. I think his inputs will be very valuable in this deliberations. I also welcome Shri Rajeshwar Rao ji, former Deputy Governor of Reserve Bank of India, and his directions, which has been in the past, has been very useful, especially in regulation, risk management, enforcement functions, and with his experience in banking supervision and financial regulation, he has played a key role in strengthening the prudential oversight and taking our economy during turbulent times. I also welcome Shri Rajneesh Kumar ji, former Chairman of State Bank of India, who served as the 25th Chairman of State Bank, and with over 4 decades of financial sector experience, he has guided the bank through critical phase of consolidation and accelerated growth, especially on the digital front. And his strategic vision, governance acumen, and deep expertise in managing complex banking operations has been extremely good. I welcome you, sir. Also welcome Shri Rajkiran Rai ji, currently MD and CEO of NAPFID, and also former Managing Director and CEO of Union Bank of India. And his experience both in banking sector and in infrastructure sector will bring depth in today's deliberations. Shri Rajiv Sabharwal ji, a seasoned financial sector leader with extensive experience in banking and non-banking financial services. As CEO of Tata Capital Limited, the company has expanded its, under his leadership, the company has expanded its lending portfolio to SME and infrastructure segments while strengthening risk management and governance. So while we discuss various areas of infrastructure finance, NBFCs of the future, I think Sri Sabharwalji's inputs will be valuable. I also welcome Madam Parminder Chopra. She is again a seasoned financial professional, over 37 plus years of experience. As a chairman and managing director of Power Finance Corporation, she is recognized for her leadership in driving growth, capital efficiency, and strategic transformation within the organization. Again, according to the budget announcement of restructuring of PFC and REC, we are sure to get valuable inputs from Madam in this regard. Thank you everyone for joining. We have, as mentioned in the introductory session from Secretary DFA ma'am, we have 4 major budget announcements which we are discussing in this webinar today. So this budget actually comes up at a very, very pivotal time of Indian developmental journey. We are looking to grow from a approximately 4 trillion economy to about 30 trillion economy in the next 22 years. So which means that the growth trajectory which we have done, which is a very fast growth which we have done, we have to look at even faster pace while going forward. So this requires a lot of efforts in terms of fiscal policy, private investment, technology innovation, strengthening of financial sector, and above all, human capital development also. So if we look at one of the major budget announcement is about continuing capital expenditure. And this is a critical catalyst towards long-term prosperity and inclusive growth. as Honorable PM mentioned during his initial remarks, that the capex of public capex of India has grown from 2 lakh crore in 2014-15 to 12.2 lakh crore in proposed in this current budget. And it represents a deliberate effort on the part of the government to enhance long-term economic capacity. So in this background, let me first reach out to Vishwanathan ji. So if you can just explain or give us the inputs on how has this sustained public capex altered India's growth trajectory over the last 10, 11 years, and how do you see it going forward, sir?
Good morning. Thanks for having me here and to be part of this illustrious panel. I think 2, 3 big things, big picture that I want to kind of say here. One is apart from the quantum, one is a quantum, other is that the government capex, the public sector capex as a percent of GDP has been going up. So that's an important trend that we must notice, and that has, to an extent, kind of replaced or has substituted the capex that is not coming from the private sector. Okay, so we must look at why the private sector is not has not invested as much as they had done in the past. There could be several reasons. There were a few bad outcomes in the past. Some of the private sector enterprises, because of which a few private sector enterprises might have become a little shy. There is a deleveraging that at higher level that we have talked about, the capex by large private sector entities. But the fundamental element is that this capex should result in crowding in. Okay, and fortunately, all these capexes have been in industries, in activities, infrastructure activities, which should result in ancillary industries developing, whether it's contributing to cement and steel, railways resulting in steel. So one possibility is that we have adequate capacity already, and therefore the current capacity is able to meet these requirements. And so the way we must plan this is to create a certainty for the private sector to say that over the next few years they need to create capacity expansion, and that is when they will start. Obviously, people cannot increase productivity or production over time. They need to invest in new factories and this is that, and possibly there's still possibly that certainty yet to come, and maybe this is the right time to make that clear that this capex for the government is here to stay. The need for higher investment in steel, cement, construction materials, and all those that are going to the capex that the government invests in will have to be provided for and supplied by the private sector. And then I think we must also we have to get back to the PPP model. Some of the infrastructure projects we had quite a few successes and a few not so good experiences, so to say. So I think it's a question of sending the right message, number one. Number two, of course, is the private sector. To get to the other part, I think it's also the second set of issues. The private sector having access to long-term funds, and that will take me to other set of areas which I think I will want to reserve when we get to the next round of discussions on this issue.
Thank you, sir. Thank you for your initial thoughts on the issue. I'd also request Rajeshwar Rao ji to come up on this topic. So while how do we crowd in this, make use of this public capex to bring in private capital? Vishwanathan ji mentioned about capacities and questions about the situations which are there right now. So how do we actually use this as a catalyst and bring in some private capital also to the investment mechanism?
No, I think I don't have much to add to what Vishwanathan has already mentioned. the challenge of crowding in the private capital is something of a puzzle which is not happening. Of course, I understand that in the last decade, because of some of the bad investments, the AQR, you had the private corporates deleveraging and also going slow on private investments. But having said that, you find that the capacity utilization has been more or less stagnant around 75 to 78% or almost continuously in the last 7-8 years. So I think we should look at identifying certain sectors which can give better what you call crowding in effects. When we look at infrastructure financing, identify those sectors and then look at actively crowding in the private investments around these clusters. I think perhaps a good way to start it would be you look at the strategic what do you call plan which has been framed in the current budget, and we can think of looking at building action plans around the budget strategy so that we can leverage on infra financing in a better manner. So I think 1 or 2 points which could be considered is we should have a bank of projects which we can finance, which are based on the themes which have been articulated in the budget. We could identify the districts where these kind of strategic plans or the projects could be actually rolled out in the times to come. These districts will be the ones which would have the strategic advantage in those particular sectors. That is one. And some of the other aspirational districts or the districts which are less powered, I think the focus of CapEx should be on building the infrastructure there. I think these could be possible mechanisms which we can have to bring in the private sector investments into these areas. I will stop. Maybe we can respond on a later bit, depending on response from the other panelists.
Yeah, thank you. Thank you, sir. I'll get to Rajneesh ji. So you also have had a vast experience in the past of financing of infrastructure projects, leading the largest bank, State Bank of India. So what do you think will be useful in today's situation? Because since we are looking at bringing in more capital apart from capex, what are some of the strategies which we can look to achieve that?
Yeah.
Yeah,
So
thank you.
if we are talking about like what is the current capex total, so it would be like if central government is spending 11, the state government maybe 6 to 7 lakh crore, and 6 to 7 or 8 lakh crore by the private sector. So it adds up to around we are spending 24-25 lakh crore. And that would mean that the state and central governments taken together, about 75% is coming from them, or 70% and 30% is coming from the private sector. The problem why private sector is not enthused about the projects is the offtake risk, which is a big risk. And second is disproportionate risk passed on to the private sector in the past. And once you burn your fingers, private capital would include in bank capital. You can put it either with public sector banks owned by the government capital or wherever you want to put it. But today, the experience of the bank, like 15 years ago, between 2010 to 2013-14, was horrible when it came to whether we finance the road projects or we finance the power projects. So banks committed certain mistakes. I won't say that they didn't commit it. Adverse selection was one of them. But today, if you look at it, there are no major, other than very large corporate houses. I'm excluding them. But you need more than that for private sector. It's not only that a few large corporate houses can meet the entire capex requirement, and there are no quality contracts. So in power sector, we know that the new payment mechanism reforms in power sector situation has improved, but there is a huge amount of, say, for example, regulatory assets sitting in the balance sheet of independent power producers. So ultimately, in the project finance, two major risks for the private party. I'm presuming that they are quality private party. But the risk is, one is obviously construction, and construction risk arises all around the approvals and delay in approvals. Second is around how to get back the money, which is a very big thing. If it is stuck with a government department, it is stuck. I sit on the board of L&T. I know what happens and how difficult it is to get back your money. So unless private sector consideration for putting in capital are different than the consideration for the government. Government can take the risk, government is spending money, and the progress is also visible, whether we see at the roads, airports, we see the railways. So it is visible to the economy. But private sector participation cannot come unless they are assured of their return of capital and return on capital, both. And for that, the bottlenecks are there, and there is no easy solution. Let me tell you, our enforcement of contract, arbitration, it doesn't work, then conciliation, it doesn't work, then High Court, Supreme Court. So the poor contractor thinks, yeah, what mistake I have committed by undertaking this project, and why should I be there? So that is, in my view, sum and substance of it. And private capital will be attracted, as I said, that they need a higher return on the capital because the risk is high. The ultimate end user is common man, whether it is power, whether it is road. Their capability to pay is much less, and then comes the freebies, free power, and all that. So there becomes I'm not going into the politics of it at all. Please don't misunderstand me. But how do we address this issue? Only then your investment in private sector getting.
Yeah, so very valid point on disproportionate amount of risk which the private sector has taken in the past and which is still lingering in their minds probably. So how do we do that? Yeah, I mean, to Sri Rajkiran ji, in all these contexts, what should be the role of developmental financial institutions like NAPFID and vis-a-vis commercial banks? What role can NAPFID play to ensure that this public capex multiplier effect happens?
Thank you, sir. While a lot of macro level issues are discussed, which very, very important, I'll get into some specific issues and the role of NAPFID. See, one of the main role is long-term financing. Actually, that is pointed out by Vishwanathan sir also, that availability of long-term financing. I think development financial institutions play a big role in providing long-term money, because most of these infra projects have long-term concession agreements, anything between 15 to 30 years. And the asset liability mismatch of the banks doesn't allow them to go beyond 10 years mostly, even though they do certain loans. So development financial institutions are cut out to do long-term financing. So actually, if you look at the sanction book, which is above 3 lakh crores for NAPFID, which we created in the last 2 year plus, about 65% of this book is above 15 years. So that is what the role DFIs play actually. And another thing is the bond market development. In our own way, actually, we have activated the municipal bond market already. We have seen more than 2,000 crores of municipal bond issuances, which used to be 100 to 500 crores every year, because we participate in a small way. It is activated. Similarly, InvITs, actually, InvITs are a good way. Today, the assets under management of InvITs are about 7 lakh crores and expected to be 21 lakh crores by 2030. They are growing very fast. Actually, they are doing bonds. They are AAA rated, and we are helping them to issue bonds. And in a way, the supply of bonds in the market may be AAA, AA, but yes, it is increasing because of this. And insurance and pension money need to get investment vehicles of this kind, which can be 15-year bond, 20-year bond structures, and all that. So, and also we have to be very innovative in designing products. We have already launched something called RG structures, particularly on the energy sector, which is made a good this thing, and many institutions have started copying it, because then the rating goes up and risk goes down. So we are able to put together 30, 40 SPVs under solar, wind, and hybrid projects and make a RG structure and lend. Actually, this kind of innovativeness is very, very important, which we bring in. So in addition to that, we also, as a developmental role, we see what are the issues in the ecosystem and why private capex is not coming. And this is very important that this, because we continue to take these issues up. Now, when you look at road sector, now why the government should be allocating so much money on the road sector when the BOT and HAM projects are doing very well? And if the government feels some of these projects, actually the revenue generation is not adequate to go under BOT or HAM, they can bring in a VGF structure, what we have brought in battery storage now. So push that, because there is so many companies waiting for the road projects to come up. Last 2 years, actually, that not much of road projects are coming up. Actually, to push the growth, actually, road sector is very important. I think we can reduce the allocation in the budget for road sector and push to other sectors by pushing most of the projects either to toll or HAM or VGF funded structures where the revenue expectations are a bit lower. But the major issue we face in road sector is land acquisition. A lot of projects are delayed today because of the land acquisition issues. Now, actually, again, we study this. It differs from state to state. Some states, the problems are more acute than some states. So we can bring a index, actually, ease of infrastructure execution index state-wise, so that wherever the states, because it is more of a state subject. So, when the government is supporting states, so if the states have legislations which are preventing land acquisition and delaying the projects, this is something which we need to correct, and incentivizing good states, so that states having a higher index, because then for a private player also to bid is very easy, because he will get projects where there may not be much problem on the land acquisition. It's a major issue. And there are climate related issues. 3-4 states we see the roads get delayed because of the climate related issues, and it's a it's a common thing happens across Kerala, Andhra, Tamil Nadu kind of states. So, why not factor that in our loan processing? Because Honorable PM also mentioned about it, saying that in project appraisal process, sanction methodology, we need to factor that in. When we have this data with us, that certain states there are delays, then why not factor in? That rather than pushing these projects, making banks to sanction the loan, then delaying the COD, making it NPA, higher capital requirement, we can factor these things upfront actually. See, then I'll come to the energy sector. Now, energy sector has done very well. And actually, if you see the transition to the renewable energy, when we say 50 gigawatts, it has come purely from private sector. It's not that it is not happening. Even taking a 5,000 crores, it is 2.5 lakh crores of investment which has come in. So we have done pretty well in the renewable energy, solar, wind, and hybrid structures. Now, there also we have two major issues. One is land acquisition. Again, there should be index state-wise, which states are more comfortable to do. And then the evacuation pipelines. The transmission has not caught up. And added to that, the PPA agreements. So if you are able to get some suggestions around this, and if the states can be very clear on these issues, private capex will flow in much bigger way. If we are able to do 50 gigawatts, we can do 100 gigawatts also, because that will bring that investment in. But then that enablers on land acquisition, PPA signing, evacuation pipelines, they have to come in. Similarly, tourism. There was a big announcement last year. There are 50 centers which will be identified where the hotels industry there will be classified as infra. That notification of which are these 50 centers is yet to come. We can expect that, because we have already seen hotel industry doing very well in India. We have seen the tourism picking up. Religious tourism is a very big thing now. And the kind of employment creation which happens through tourism is, the multiplier effect is manifold here. We should encourage that. Similarly, urban infra is an area where, while I mentioned about municipal bonds, there is an urban challenger fund which has already come in, and last 1 year not much work has happened. We can push this, because solid waste management which produces power or biogas, sewage treatment plant where the treated water can go into industries or thermal power plants, this kind of, and then the urban mobility, these are bigger areas where we can do a lot. So I think while there are macro issues, we can push the smaller things which are within our hands, and which will activate certain markets. And in 4 to 5 years time, lot of other things will flow. Actually, we can't preempt some of those like the bond market issues and all that. But then, if you have sufficient issuances and all that, then I think gradually things will move. And insurance and pension funds ultimately have to look out to invest to these sectors. So that will activate. I'll stop here.
Thank you, Rajkaranji. I will also request Mr. Sabharwal to give his points of view, especially from an NBFC perspective, and probably doing projects also with the SME sector and small infrastructure projects. How can these projects be picked up quickly and private participation can be ensured?
Thank you so much. I think so much has been said by all the participants, and I'll just add something which we have felt which are different. Actually, if you look at it, there are certain sectors which have got enough of financing available. Like Rajkaranji mentioned about renewable energy, I don't think so there is dearth of financing there. Actually, the challenge there is that because of competition, the pricing is becoming such that now the lenders also are finding it difficult to make money there. So if you look at areas like transportation, power, renewable energy, even logistics, airports, I don't think so there has been dearth of financing there. There have been challenges relating to land acquisition and other areas. But in terms of financing, I think as long as these projects are there, there is enough financing available for these. I think there are new areas which are emerging, which are becoming more important, which is where there is still there is more uncertainty, like EVs. We talk about for the batteries or setting up plants for that. We also do not have full clue on how to evaluate and how to look at it. Or actually all plants, even solar ones, will be with pump storage. So that adds another nuance to the whole thing. Waste to energy or green ammonia or green hydrogen. These are new areas. These are the ones which I believe will require more support, more understanding of how to set this up and how viabilities will come to these areas. Similarly, data centers, we've all been used to financing data centers, but the new data centers are very, very different. They've taken a lot of these chips and all. And recently we had few requests. We honestly don't even understand what will be the life of these chips. And the big cost is lying in these chips, not in the physical infrastructure which is put there. So, this whole concept of guarantee, this is required more for these areas, new areas, where things have not got discovered. The areas which have got discovered, actually, there's no need of doing any guarantee or anything there. There is enough, debt which is available, which can support these projects. The other thing which we feel in SME, Rajkaranji will also certify that some of the areas lack enough equity capital from the promoters who come in. And that is equity and all of these areas, ratios go haywire. And to meet some of these equity requirements, then you have structures which are possibly not good. And recently RBI has also commented on them, where the debt is raised at the holdco level, which comes in the form of equity at the opco level. So I think while we look at how to support new technologies, we also need something how to support these entities with equity. And that is especially on the SME side, and that is what we are feeling is a need to do so. We ourselves are trying to set up with the support of people here, with NAPFED also, trying to set up some AIFs which can provide equity also to these entities, so that both the ends can be taken care of.
Thank you, Rajiv ji. As an introductory remark, I would also request Harminder ma'am to come in especially Rajkaranji mentioned about some of the, while energy sector has reasonably stabilized in terms of infrastructure financing and infrastructure development, he still mentioned some of the key challenges which can, if resolved, can bring in more private capital. So, ma'am, from your experience, how do we conquer some of these challenges, like land acquisition, evacuation challenges, PPA challenges, which comes in the power sector, etc. So, what can be done to ensure that more financing and more capital comes into these areas, especially in the power sector?
I agree with Mr. Raj that there has been power sector from the point of view of the infrastructure financing has more or less stabilized because of the consistent policy approach which has been there from the government side. So if we say in the power sector, there has been lot done, whether we talk about the flowing of the cash liquidity in the system through the late payment surcharge scheme, which has improved the outlook of the power sector immensely. And you are seeing that a lot of capital is flowing into the power sector, and especially on the renewable sector. One major observation is that wherever the major capex is required, private sector is generally shying away. And if we talk of the renewable sector, the quantum of the capital investment is comparatively lower as compared to the conventional power sector, which we talk about the thermal and as well as the hydro sector. So what has given the renewable a push is one, the smaller ticket size. The other is that there is basically there is a clear-cut revenue stream which has been there on that, because when the projects have been allocated through SECI, the PPA is already there for a period of 25 years. So there is a confirmed revenue stream which has been there. And on the policy front, I would say that there has been always an inclusion of the private sector in the policy making process. So this has also helped especially the renewable sector and more participation of the private sector in that. And what I would like to mention is that the early financial closure, because the gestation period is low, because there is the revenue is flowing, that they are able to have the early financial closure, and accordingly we have seen a very less number of cost overruns and time overruns especially in the renewable sector. So all these factors, when combined, has led to more and more participation in the renewables. Now from the renewable sector, we are looking at the energy transition, where, as already mentioned, that there is a lot of technological challenges. Technology is fast changing. So there needs to be some intervention, and I think there is companies which has which has the capability of giving the early closure along with some helping hand, or we can say the VGF type of, like the battery storage, which we have seen in this budget. So these type of schemes will take it in the fast forward mode for these technologies.
Okay, thank you, ma'am. And I think from an introductory perspective, we have been able to identify quite a few of the issues as well as some of the areas which we have to improve. And the panelists have also brought in key points like what needs to be done. So that's also an important aspect which has come in. And when we take a summary, it looks like the risk levels, some of the promoters take or the financiers takes seems to be a little more, or that is impacting private capital coming in. So in this context, if we look at the second budget announcement which we are discussing, that is around creation of an infrastructure risk guarantee fund.
Can I just comment briefly on one or two points? Just
Yeah, please, sir, please.
sorry, I just was just thinking one. Is it? Do we have a study? Maybe if Rajkiran Rai or somebody could let us know this private investments over the last 5 years. Which are the sectors where they have invested, so that we get a sense? Because Rajneesh ji mentioned that about 6 lakh crores on an average is an investment which is being done by the private sector. So which are these sectors and what is the focus of these private sectors? If we get a sense of that, then maybe we could understand what exactly are the hindrances or what are the constraints which are coming out. Maybe a study on that could be considered. That's one point. Second is in the new growth sector, since a lot of growth is happening more in the services sector or in the new areas, is it actually more of an asset light sectors which are growing? If that is happening, then obviously the private investments would be less than what is expected by us through our budgetary processes. So I think we need to have a better sense of how this two are happening. And third is whether many of the private sectors find it easier to go in for imports to grow their businesses rather than invest and produce in India. Whether that is also a aspect. I think these 3 points also are some issues which we may need to debate to get a better sense of what is happening.
Just to add, sorry, Vishwanathan here, just to add to what Rajesh has said, the last part is very important. I think quite a bit of the solar plants that are coming up, very import heavy. You know, I think there's a lot of discussion on how do we make our solar energy system more, Atmanirbhar than requiring imports. So some element of issue there as well.
Okay. Yeah. Thanks, Rajeshwar ji and Vishwanathan ji for those interventions. I mean, clearly, there has been studies off and on why private investments are not coming, but deep study probably is one of the requirements that we see. While we say that it is not crowding in, why it is not happening? Are there any, as Rajeshwar ji said, whether is growth happening in asset light sectors? Then probably the investments also will be, toned down according to that. So maybe we can look at that as a part of our overall recommendation from this webinar. And now coming back to the risk management piece, one of the key areas which came up during the initial discussion is the more than proportionate risk which a private developer or a concessionaire sometimes take in terms of implementation of the projects, especially at the project level, when the projects have not gone operational or cash flows have not steadied. So it is in this context that the second budget announcement which we are discussing, that is the establishment of a infrastructure risk guarantee fund, comes into play. So while we discussed a lot of about the bottlenecks in infrastructure financing, given the national infrastructure pipeline, there is a huge pipeline of infrastructure development which is planned. How can this fund be used or structured to ensure that these projects take off and private investors' risks are mitigated to a very large extent? So how can this fund start and evolve into a larger entity? These are some of the questions I think which we should look at from implementation of that budget perspective, budget announcement. In this, I would request Rajneesh ji to come in and based on the historical events of the past, probably the 2014-15, around where NPAs kind of spiked, the projects went offline, things like that. How do you think, sir, that such a kind of a fund will enable or help banks to improve their confidence and improve their risk management in financing the projects?
So my take is a bit different on this infrastructure guarantee fund. You mentioned about the huge NPAs. Imagine a situation there was an infrastructure guarantee fund that would have gone bust in that scenario where you had almost 8 lakh crore of NP in the infrastructure finance. So any guarantee funds can only assume a very limited risk. So the way guarantee fund would work, I don't know what is your plan around, is that the appraisal would still be done by the lenders themselves. And when there is a availability of comfort, we have to be very sure that the standard would not be lowered of the app. So in my view, we need an institution. I mean, I'm going beyond what the scope of this or how it is envisaged. There is a lack, and that's what Honorable PM also mentioned, project appraisal skills in the country, despite we have many lending institutions like PFC, RCC, State Bank of India, then now NEFIT. But the capability to really assess risks in a very holistic manner, that is absent or not available at a very large scale. Even NEFIT, they would have taken people and Rajkiran in those from the existing banks or the new cadre, new pool who understand really the project appraisal risks. I think we need to do a lot of work in that area. That is wrong. So an institution which not only guarantees or takes the risk, it also has to do the capacity and capability building, not only current. That is one point I wanted to make. Second is, if you're really envisaging an institution like this, then collaboration and international collaboration, probably locating it in a gift city could be a good idea. These are all ideas, theory. You will have to further discuss, deliberate, but these are just some of the initial things. Third would be, an institution like this should do the project appraisal, right? And then it may take a little bit of participation to ensure that there is a skin in the game. Say if the project is, say, 2,000 crore. This institution appraise this project, make it risk-proof, and then go to the lenders, is 2,000 crore, 200 crore I am putting in, or 100 crore I am paying, rest you take. There's a mismatch. We have to understand. The liabilities or the money is with the banks, right? And their capability to assess the risk, accepting maybe State Bank or one or two larger banks, is very limited in appraising the real risks. And they learned the hard way when they sanction left, right, and center on these road and power projects. So how do we make and reduce the risk? And that can be done through an institution which is really capable. Even NEFIT can do it because they are the institution. They can do it. They can have an approach where with the government support, and they appraise the project and circulate and take a participation in it, and then de-risk the project. But still, RBI would expect, and they will say in their circular very clearly, that every lender has to do the risk appraisal. It doesn't mean that the risk appraisal would not be done by the lenders, but still, if there is a what do you call it, typically a merchant banker role, where it comes with the participation. Merchant banker, what it does in the existing system, it doesn't participate in the risk. And that is where a lot of criticism also came around when SBI Capital Markets, they were doing all this intermediation. They said, where is the risk? You're not taking the risk. So we have to probably improve that model that, yes, you're saying this is an investable project, you have done the appraisal, but how much skin you are putting behind and how much conviction you have behind this project. Then I believe that it will have a better chance of reducing the risk. Ultimately, if the risk is high, there's a cost. We are talking about efficiency, we are talking about productivity. But if we don't reduce the risk, then the cost of intermediation is very high. The borrower would end up paying One is on the whatever is the lender's margin, and on the top of it there would be a risk premium. So if we have to think like today, if you look at the risk of a project, no project is viable for the lender on a risk-adjusted return basis unless you charge 15 to 16%. So not only there was a risk, higher risk, it was an underpriced risk. And if you say that because of the risk in these projects, these are greenfield projects, so I will charge 15%, so project in any case will become unviable. It is a chicken and egg situation. So the emphasis when you're envisaging this fund has to be more on risk appraisal and de-risking the project.
Thank you, sir. It's a good concept that just don't be a passive member by issuing guarantees and risk mitigation. Be an active participant by doing a clear, comprehensive risk appraisal, and the standards needs to be developed. Probably,
otherwise, it will not work. Your premiums will be very high.
Yeah, so probably it's time to look for a specific institutions which can create these capacities also among the HR resource in the infrastructure finance sector. Thank you, sir, for your those thoughts. I would also request Rajkiran ji to come in here, because as a lead practitioner of infrastructure financing in the country now, leading the institution which is probably going to be the largest infrastructure financing institution over a period of next 3 to 4 years. How would you think that such a kind of fund, what should be the focus areas of infrastructure? Are there any specific, like you mentioned in the initial discussion, that some sectors have stabilized? So every sector, do they require? How do we ensure that some of the geographical risks are addressed? What coverage should be given? Can you throw some light in some of these factors?
Yeah. Thank you, sir. Again, first I'll touch on the structure part of it. While structuring these kind of guarantee funds, we need to keep the regulatory guidelines in mind, because in addition to giving a comfort to the lender that there is a guarantee available, it should also result in capital relief. Because moment there is a guarantee, as per the Reserve Bank, it has to be set up keeping those regulations in mind. So that moment a project is guaranteed, it gives us a capital relief, which will result in low interest rate to the ultimate, the private private company which is going to construct this project. So actually that will more than compensate the premium what he is paying. So that's why when structuring, you should ensure that regulatory relief is available, so that when the the bank guarantee, the commission on a guarantee, which can be between 0.5 to 1, gets covered by the interest concession. That is very important, that to be kept in mind when we are structuring these kind of guarantee funds. We already have that for MSME and others, which is working very well. So that experience is already there, that those kind of things can be looked at. Now, some of these suggestions that guarantee should not be freely given and we need to do the assessment, we also look from the cost perspective. If the guarantee structure is created and if they have to go through the whole appraisal process and do the risk assessment, then you have to build a bank there, actually. Go through the whole process and assess the risk and then price it. So it is impossible to do that, because then it will not be viable. We have to depend on lenders, subject to certain covenants, ensuring that the lenders follow certain basic principles. Like the NAFID can definitely support, and a team, when every project comes for guarantee cover, some basic checks can be done. Some covenant and all that we can standardize, so that once that is followed, then it should be eligible for guarantee. We should not recreate another structure at the guarantee company level to go through the whole process. We will add to the cost. That is another thing. And what sectors to cover? Like I have an example, like hydropower. Now, whole of Northeast and some of the bordering states like Nepal, Bhutan, and all that, we have a lot of planned hydro projects which never seen the light of the day, because the climate risk is very high. So, if this guarantee can activate all the hydropower projects which are allotted, waiting, last 10, 15 years, a lot of projects are there. They are, actually, because the climate risk is too high, and it is not, this is easy to cover that kind of risk. And risk should cover at the portfolio level. It is not that you feel one particular project is higher risk and then we'll cover that. That should not be the this thing. We should definitely ensure that the portfolio level cover happens, because then your probability of default works for that. Because otherwise, all your calculations on guarantee cover will go away. Suppose if I say in hydro projects, like there's a 5% chance of default, you can't collect premium selectively. You have to collect at portfolio level. I also see a scope in urban infra. While we don't need it in established sector, which Mr. Sabharwal also mentioned, but urban infra is a upcoming area where there are a lot of issues on this thing, because urban local bodies are also a bit unpredictable in their cash flows and all that. A good cover there will help, and help lenders to encourage many of these projects, because see, urbanization is a in thing. We need to see that when we are talking of Viksit Bharat, it is also aligned with more of manufacturing activities, more urbanization, and then a lot of other things like affordable housing, connectivity, solid waste management, everything comes in. Now here the guarantee can cover, and that will give a very good comfort. Along with the Urban Challenger Fund, a guarantee cover can work wonders, because actually we are already, cities, infrastructure decaying. So now this is something we can look at. So certain sectors we can say that will give a guarantee cover, and looking at the success of these sectors, then we can expand it to other sectors as the new sectors come in. Wherever we feel that private capex is not happening, and wherever the lenders are not comfortable lending, where we see higher risk, such areas this fund should operate. This fund should be not a relief for anyone. It should be enabler for private capex, because that risk of unpredictability, in particularly during the construction stage, should be taken by this guarantee fund and enable more creation of assets, which we need actually for the next 20 years. We need to have much cleaner cities, much better cities, and then this will go a long way. I'll stop here.
Yeah, thank you, Rajkaranji. Now, if I ask about from a NBFC participation perspective, whether these kind of funds, especially to cover the construction or the project phase risk, will they help in much more participations from larger NBFCs? Probably Mr. Sabharwal can throw light on some of these questions.
No, thank you so much. I'll build on what Rajinshji and Rajkiranji mentioned. See, actually, from our perspective, we see that this fund should help in more financing being available rather than money coming at a lower interest rate. Honestly speaking, already margins are very low in this business. If you further bring it down, I don't know what incentive we will have to lend to this. So India there is enough competition to ensure that the rates are low. That is why you've seen that despite the regulator bringing down interest rate, margins of none of the players have improved. So what we need is structures which will lead to more money being available for this sector rather than cheaper money being available. I just wanted to put that point from our side. The other is, I think this will be extremely helpful. Obviously, we will need to look at how this is structured, whether it is equal sharing from the beginning, whether it's first loss to the extent of 5% or whatever it is. I think if it is to the extent of first loss, it helps more. It builds in more confidence in the whole system. And after that, we should not worry, because if we lose money in this, it is not that the first loss will be lost. The rest of the money will also be lost. So no lender will compromise on this. I think assessment should be done by the lender. That is very, very difficult to imagine whether the credit fund will be able to build capabilities. However, I do agree that when we are creating this fund, if the government can also look at what more can help to make this sector better. For example, Rajneesh ji mentioned about capability building and capacity building. Well, whether there can be another smaller allocation of fund which will focus on that so that we build those capabilities. Similarly, some of these projects may need equity support also. So while there could be a guarantee fund, there could be a need for an equity fund also being available, which can also step in, and it can become a profit churner thing, because as projects become big and they go public or they find an exit, the money will also come back and it can become a self-sustaining thing. I think in the past, if we look at what challenges have occurred, because finally we don't want to use the credit, guarantee fund. We want it to be there, but we have to find a way to structure projects so that we don't need it. It's only an eventuality it comes in. So, in the past, structures for payments and otherwise have got created, like in, SECI got created or HAM projects came in. So if we parallelly focus on ensuring that before projects start, most of the land acquisition has happened, and the guarantee fund will step in there, then we also know that the project will see the light of the day and it will go ahead. And we create mechanisms for payments. Just one of the things I wanted to mention, whenever problems occur in a project, actually it becomes very difficult to resolve. Whether it's a case of land acquisition, it may be the last 2% or whatever it is. But those problems occur. We don't have a body which actually, brings about resolution of those issues. Like, it's like a PMO. You create a body which helps bring everybody together and finally solves. So we don't have a body for infrastructure projects which addresses the issues whenever there is whether it could be a state issue, it could be a center issue, it could be anything. But we don't have a redressal body which takes quicker actions. If you go through the legal process, it will take a much longer period of time and the projects will get delayed. Parallelly, I feel, there could be a need for the regulator to also look at, in case the project has got delayed for some genuine reason and we are pushing the date by a year or two, do we really need to put in more capital to support that project? Or it was beyond, it's not that the promoter has put in less equity or the project is not funded, but the project is viable, everything is there, it's got delayed by a year or so. Do we really need to allocate more equity to the capital? The moment you do it, your return on capital will drop. Just a few thoughts on that side.
Yeah. Mr. Hampton, can I make a comment?
Please comment.
So, what probably you would need to do, and again, you can take a call, probably you will need some sort of a internal group or a working group to deliberate on this. Because if this is not structured probably, if it is not structured probably, there is a risk that this fund will ultimately prove not to be sufficient or may go bust any day. Its actuarial valuation is involved, risk assessment is involved, how much capital they will have. There are a lot of issues, there will be a lot of issues. And when I was making certain suggestions, the model which I had in mind and which also need to be kept in mind is MEGA. It's a World Bank group. There is a MEGA institution. And it does a lot of such activities which I mentioned. Being a lender is not everything in this country which we need here. There are sufficient number of lenders. What I am aiming is that how we really appraise the project and reduce the risk. So that has to be understood the context of what I was saying. लैंडर तो रिस्क लेके और करता ही है, तब भी तो सारे प्रोजेक्ट्स आपके जो है ज्यादातर फेल हो जाते हैं ना, दिक्कत तो ये है. So we need to go beyond lenders' capability. It is not only about taking the risk, it is the capacity enhancement in this country where your project pipeline in the next 22 years is going to be huge. We have to study that why doesn't airport have an NPA, but all the NPAs are in road sector and earlier in power sector. So I think like Rashkina is a very well, you can have two institutions. What is there? In this budget you have fund. Next year you can have another institution. So like if you have to have this institution, I can tell you that it cannot cover large projects for sure. Then it will be for like a project for 500 crore, 600 crore, so that there is a portfolio. For any insurance to succeed, you need volume. If it is concentration, you're gone. We know it very well. So guarantee is nothing but an insurance. And it cannot work unless it handles or covers thousands of projects, and then if you fail and it doesn't go well. Earlier we had problem in CGT, MSC, at such time it got then capitalized because all the loans were going bad. Because everybody thinks if it is guaranteed, I did not pay. So we have to keep that also in mind.
Just one point, if I may add to this, to what Rajeshri mentioned. You know, one is the whole appraisal which is done at the initial stage. A lot of times, the problem may not only be there, the problem may come up later. After the appraisal is done, part of the monies have gone into the project. How do we find also a mechanism to take care of that? I don't have a solution, but that is also, it is not only that if you think through the whole thing at the appraisal stage, your problem is solved.
नहीं मुझे तो पता है ना मॉनिटरिंग में तो सबसे ज्यादा दिक्कत होती है वो तो विश्वास सैंक्शन में क्या होता है
I'm reserving my comments. Okay, I'll come when I have.
Yeah.
Right. Sir,
No, no,
actually,
since,
just a small,
yeah, please
point
come in.
Yeah, because Mr. Sabharwal mentioned about the dispute resolution. This is a very essential part actually, because when you talk of attracting private capex, we need to have a very solid dispute resolution mechanism. NAFID Act as a provision that we should act as a dispute resolution agent also. We have also shared a concept note around this. So I think this can be a part of the recommendation where NAFID will create a structure for dispute resolution even before the arbitration and it gets to this thing, because many of those issues can be solved, because that will be another solution to attract private capex. On this issue of project assessments anyway, it is a call to be taken, but then we should not be creating a guarantee fund structure which is very costly. But then while we have to take care of all the project risks at lenders level and all that, somewhere we need to standardize certain things and have to trust people, and maybe a very, very senior level team can really look at it, how to structure this so that we should not add to the cost, but facilitate, because we work closely with MIGA also, because their processes are so long. I think whether our country can wait 1.5 years for one particular guarantee to come in, because in MIGA you have to work for a year to get a guarantee to come in. So I think maybe we need to find a way in between. That's anyway, as suggested by Rajni sir, I think we need to have a working group to look at it. Thank you.
Yes. No, since Sabharwal ji also mentioned about the risks which emanate after the project has started. So I'm just putting in a thought on the go. Can this risk guarantee fund look at only cost overruns in such a case? So that if a project is stuck, if the lender is funding the cost overrun with a viability study after a detailed revised TEV study, can the fund look at only those projects?
And we can create an alternate investment fund for that, sir.
Yeah.
We can create, rather than a guarantee fund, because this is a direct funding actually, so I think
I think the idea would be that the banks will fund the cost overrun, but this fund will look at guaranteeing that cost overrun part only.
Yeah,
So
I'm just thinking because
Yeah, but ये थोड़ा deliberation के points हैं. All these points
This
require
requires more details.
It may not always be a cost issue, as Rajkiran ji was saying. It's not always a cost issue. It is a dispute resolution issue. I'm just saying, sometimes how to get, so, the country is looking forward to you, Rajkiran ji, because, you have the capability now, as you said, to net equity as well as resolution.
yes. Yeah, Rajeshwar ji, आप कुछ बता रहे थे.
No, I just
Sure.
had one thought, though I understand this is more as an infrastructure risk guarantee fund, but whether this could actually be aligned with your strategic and frontier sectors which has been outlined in the budget. Because those could be ones which are less capital intensive as compared to the conventional mature projects which come in the domain of infrastructure. So this could then actually become a catalyst for the emerging sectors to take off. So whether that could be also an option which could be evaluated is something which we can think of, because then it can be less capital intensive, this infrastructure guarantee fund. So just a thought, which I will leave it with the group.
Okay, thank you. Thank you. I mean, we'll move to the third topic, which
May
is.
may I say
please.
something?
Yeah, please, Vishnu.
Yeah. I think I have a few comments. One, I think we really need to understand the objective of this fund. Okay, if you globally look at what's happening, studying, what does KW do, what does Korean Development Bank do? There the entire it's the fundamental financier of infrastructure. Okay, number one, and in fact, for KFW, it's almost entire money. Most of it comes from the government, and there is bonds which are guaranteed by the government. Okay, two. Same does KDB. They raise money. So I found in their balance sheet about was $17 billion balance sheet. They're about $1 billion of deposits. Otherwise, it's essentially all bonds, which are again guaranteed by the government. And there is a mandate by law for the government to capitalize that entity. Okay, the larger point I'm trying to make is that the long-term, long gestation, high construction execution risk projects which are of national importance. Okay, I'm not saying steel making. Okay, those are largely kind of funded by the government, directly funded by the government, or funded by bonds which are guaranteed by the government. Both for the reason that it reduces the cost, because I think it's an egg come chip come first issue again, because I think if you have a high cost project, then it becomes unviable at a later stage. But I think I agree with both Mr. Sabharwal and Mr. Rajneesh, because I think it's not just suppression, because I was with IFCA for 2 years. Okay, I know that Industrial Finance Corporation of India. But Mr. Rajesh knows many of those are not just suppressive issues; they are real, at the ground execution levels. There have been failures. I'm not saying financing entities, institutions have done their job. They have come out flying colors all the way. Not at all. But I think there's a lot of issues that, and I think I'm very happy when Madam said today that the PPS are 25 years, because if I remember right, the 14-15 time, many of the PPS the government wanted to be rewritten. Projects which are implemented based on a particular unit rate, they wanted to get rewritten, which makes which makes a project unviable. Okay, so the way I'm looking at it is, what is the risk that this entity is going to cover? If it's a backstop, then as Mr. Rajesh says, is it enough to cover a problem of the kind that we faced? Not really. Or is it a way to say, okay, here is the first loss? I think so. Again, we must look at what the structure is going to be. Is it the first loss default guarantee? Then it will have more people wanting to come in because there's somebody taking the loss. Okay, but if somebody has to take the first loss, should it be taking up without appraisal, or should it be because I'm the government? I'm guaranteeing it. It's my job to guarantee because I want infrastructure to have. So I mean, I think, Mr. Epin, my view is that on this, a lot more discussion needs to take place, because I think what you have is a very, very faint idea. Multiple thoughts have to go in. Having said that, we have an interesting model on the roads, which is that the government funds it, NHAI does it, and then monetizes the asset. Right? So the construction execution risk is not borne by the private sector. So the shorter point I'm going to tell is that we must get the details of what we want this entity to be. My view is, particularly my personal view is, this can even be sitting within AFID. I don't think we should create another organization to fund. For example, SIDBI is operating this one, right? Yeah. The small finance, yeah. MSME fund, they're doing that. So you could do it within the, don't create another institution. But I think we must get what it is trying to actually achieve. Is it a case where the government is avoiding to have to put a lot of money, but at the same time, so that I'm behind you? The ECGLS is a very good scheme, right? During the COVID, the government did not put money, but gave guarantees to the banks, and that made banks give money. So it's a what you call interesting design of avoiding fiscal, exposure immediately, while at the same time using the fiscal support, the availability of fiscal support at later time to make private investments happen. I don't very clearly agree with Mr. Sabharwal on costing. My view is that ultimately the cost should include. We didn't include, maybe is what Mr. Rajneesh said. The cost did not include the construction risk adequately, did not cover for them. So ultimately, if there is somebody who's going to bear the risk and cost arising of that risk materializing, the overall cost should come down. I think that is the way we must, structure. But how will it operate? The details have to be worked out. It's an interesting concept, but if we don't get the implementation part of it very right, I think it will go heaven. I agree with Mr. Rajneesh on that.
Yeah, thank you, sir. I mean, great inputs from all the panelists, especially a lot of interest I can see in the sense that we are at a very amorphous stage with this fund. I mean, actually, what the fund should do. The recommendation that we should have a working group to work out, thrash out the details is a really good one, I think. I mean, so we can suggest this as one of the recommendation. And as Vishwanathan ji said at the last point, that it is not completely about taking out the responsibility of the government in funding the larger projects. It's about government creating that multiplier effect to ensure that financing happens at much larger scale with such kind of interventions. So we'll now quickly move to the third aspect of the third budget announcement which we are discussing, and probably I think one of the most talked about budget announcement in terms of financial sector. Probably a committee after to look into the financial sector, banking and financial services after three and a half almost 4 decades. We had the Narsimham 1 and 2 committees. After that, such a comprehensive review of banking sector has not been planned. So in this context, I would request again Vishwanathan ji to come first. I mean, what do you see the importance of this committee in the current scenario, especially looking at, we have discussed a lot about financing needs, but then there are other smaller needs which comes from various other smaller entities, financial inclusion, the growth aspirations, the sunrise sectors which come in, the way the financial sector itself is going to change, the way they lend, the digital, the AI coming in. So we are in such a kind of a flux situation in which this committee is being asked to be formed and looked into the issues up to 2047. So request your thoughts on this, sir.
Yeah, it's a very big topic, but I think the way I want to place it is like this. Since we are giving the context of the nursing committees, I think a lot of water has flown to the Indian financial system, the Indian banking system, and the Indian economy in those 30 years. Okay, we are a lot more modern economy than we were at the time. Perhaps one of the highly digitized, payment system globally that we have. We have a robust banking system. The problems of NPAs are largely gone. We can still get back to that cycle if we don't learn the lessons of the past. But I think the larger issue that I see is our current banking structure the right structure to propel the country forward and be ready to finance an economy that will be the Viksit Bharat in 2047 and will take India to that direction. I think that's the first question that other committees should ask. And I think the answer to that in the normal course will be, no, we are not. We are not there. And then we look at what are we supposed to do to get there. Okay. And that will include structures. Okay, that will include sizes, that will include competition, that will include entrance. Okay, so for example, I think the RBI has what do you call made this universal bank licensing on top, but I don't think, maybe I don't even remember there were any applications. Rajesh will know better than me, but I don't think any of them made it. So we must look at, do we need more banks, or do we need more stronger banks? Okay, because like in the US, there are, I think it's like, if you look at what do you call the HH index, which shows the index of competition, we have a very high index. I mean, low concentration that way. In the US, it's just 2-3 banks which will take care of almost a big share of the banking system, and most of the other requirements are met by the local banks. So you have state, federal banks. I mean, each state level banks, and they have federal banks. Okay, so whether we need that type of structure, we also need to look at what our public sector banks should be doing, because I think in the past the public sector banks, I think they are not doing anymore as much, but the public sector banks were kind of dispensing the or providing the fiscal responsibility to the government. That's what they were doing. Right or wrong, I'm not getting it. So those are things to be assessed. Okay, and further, we need more capital. If the country has to grow to the level extent that we want to be the Viksit Bharat by 2047, it will be the financial sector that will propel it. Okay, and the big part of the finance sector will still be banking. And except for US, I don't think anywhere else the capital market is the biggest financial services provider. It will still be banking, whether it's Europe or even UK. So I think we will have to look at, I think, banking system from that perspective, number one, which will also include, in my opinion, maybe getting provocative. Are we getting right on the priority sector? Are we getting right on the what do you call directed lending, as one would call in larger picture? Is there are our regulations more principle based, or are they rule based? Are they saying you do like this, do like that? But incidentally, though, I was just before coming to this, I was looking at the global practices. Some of them are almost like what we do, even in advanced countries like UK. At least here we don't approve appointments of CRO. They approve CRO appointments. They are only looking at CEO appointments here. In UK, CRO appointments are approved by the central bank. Okay, so maybe some of them we are not as archaic as we think we are. So I think the way the three big themes for that committee will be: is this current structure capable of, propelling country to the 2047 and cater to that type of an economy? Number two, if not, and in my opinion it will not be, then what should that be? Within that, what should be the role of public sector banks and private sector banks? And five, we had this. It was the what do you call Khan committee report, the former IDBI chairman, who brought this whole concept of universal bank. Which of course led to the complete extinction, so to say, of the development international institutions. So whether banks should be, getting into what do you call investment banking? Should they be funding large projects? Otherwise, what are the opportunities? Are there other things that they can do within the framework than they are being authorized to do today? Other relaxations that are possible, tightening somewhere. So I think three things. And then, do we want very large bank? Do we want a large bank? There's this whole concept of having a global sized bank. But again, I was interested in looking at the ICBC balance sheet for some other context. If you look at, I just don't know how they work. It's still a maze to me. They work on an LCR of 120, 25%, 130% all the time. If they're so highly liquid, where are they making the profits from? I don't know. They still make profits. So we must look at what is it that the globally large banks are doing. That's what I think this committee should look at. What is the driving force behind the globally successful large banks? Are there things that we are not letting our banks to do, and what way we can get them there? So, for example, the current decision to have banks do acquisition finance, it's a big step. I mean, with a lot of what do you call caveats, though. It's a big change, at least in terms of approach. But I think we need a lot more of those, and it should come from a very detailed analysis. One small point I want to make, that some of the prudential standards are now global. Extremely difficult for a country like India to make its own beyond a point. We tried in a few cases, and the Basel committee came down heavily on us. So we have to be very careful on that. So it's not those standards that we will be looking at. It's the operational part. I think the committee should, whichever committee is there, and most importantly, the structure and the role of public sector banks.
Thank you, sir. I mean, I'll take to Rajeshwar Rao ji from where you stopped. You mentioned about Basel committee and the operation. I mean, you maintain the guidelines around that. So, do we actually? It's a probably a little controversial also. RBI is seen as a little more stringent than Basel when we look at it from the terms of ratios which has been stipulated, whether it is CET ratio, liquidity ratios for DSIBs, etc. So, sir, in your opinion, whether the time has come for a committee to look into relaxing some of the tighter controls which probably would have been created in the period of earlier volatility?
No, I think while I agree largely with what Vishwanathan has said, I think when it comes to these norms, I think the norms should be left to the discretion of the regulator, because if they will look at the risk profile of the institutions which they are regulating and then work out what is appropriate for India. I think in the Indian context, perhaps given the kind of recovery mechanisms, the etc., which we have in the country, a higher capital threshold was considered necessary at that point in time. But going forward, depending on the mechanisms and the infrastructure or the frameworks which we have, the regulator could take a call. So I would leave it more to the regulator discretion rather than making it a prescription through a high power committee. Having said that, I think we should also look beyond what Vishwanathan said, that while capital raising for the new entities is going to be a challenge, what mechanisms are available, what kind of structures would be necessary, especially for the public sector banks. We should look at consolidation of the public sector banks. So I personally am not very sure whether having a large bank is per se a criteria for enabling us to achieve a what do you call competitive financial sector or facilitating an advanced economy status. But we have a very well diversified set of banks. I think that can continue, but they need to necessarily grow, and to grow they need capital both for credit growth as well as for investments into the operational sector. So how do we finance that is something which the committee could look at. Concomitantly, there would be need to expand the remit of risk management, the risk suite of risk products which the entities would require, the financial market infrastructure which has to be there in place for these large entities to operate in an advanced economy status. So what could be the roadmap for improving the financial market infrastructure, the digital financial infrastructure, etc., could also be something which can be considered. Another interesting point was the resolution process. I think recently there was a speech by one of the deputy governors of Bank of England, where I think there is a efficiency of capital or a lower requirement of capital if the resolution processes are much better laid down. So the committee could also look at this resolution process, because that can then free up some capital resources for the financial entities. Along with this, I would also suggest the committee should take a look at what are the current statutory frameworks, because we have over a period added on the statutory obligations, the roles of the regulators into the various acts. I think there is a need for a bit of cleanup on that, because typically you look at RBI Act, the entire edifice for the NBFC regulations is put in Chapter 3 of the RBI Act. Maybe we should think of coming out from that. NHB, again, some parts of the housing finance regulation is coming in the NHB Act. Then we also need to look at rationalizing the RRBs, which is another area of. And also, when we look at capital for growing the private sector banks, aligning the voting rights, the levels of investments, those are some of the kinks in the regulations. Not exactly kinks, they were appropriate at that point in time, but we should have a rationalized or a relook at some of these issues. So I think these also could be some of the areas with the high power committee could look at going forward.
Thank you, sir. So you brought in very interesting aspects like resolution process, statutory regulation, bringing remit of risk management into the committee's terms of reference probably. very valuable. But one point I would pick, and I would go to Rajneesh ji on that. Rajeshwar Rao ji said about the need for whether bank consolidation is required, whether we need large banks or more banks. So, as a practicing banker, how would you see whether practically this may not be a dichotomy? We may need large banks to write and take a larger risk or underwrite larger checks. But at the same time, from an inclusion perspective, we may require more banks or more branches or more outlets. So, Rajneesh ji, in your view, how do we address these multiple challenges, or what could be the committee be looking into in these aspects?
Mute.
So you're on mute if you can. Rajneesh ji, आप mute में हैं.
So, like, my wish list is a bit longer than what has been said, and again, it will require deliberations at your end. But what I feel that whatever we do now with this high-powered committee, one is that it has to assess the needs of the country and their pride. So today, your composition of GDP is 55% services, 30% manufacturing, and 15% agriculture. So we will have to look that every 5 years what is going to happen and will be composition of our GDP. And then once we have done that, then how much capital support is needed from the banking system and whether domestic capital is sufficient or how do we bring in international capital and what role domestic banks play in facilitating that. So that would be one mandate for sure. Some of the key trends which are very visible, one is, we have already discussed a lot about infrastructure financing. Another is your climate financing area. Then your AI and digitization is reshaping the banking sector globally. Then your payment system and digital currencies, that is another. So the mandate of the committee would be, as I said, how to attract international capital for meeting or supplementing the domestic capital, which is obviously not sufficient or adequate to have a higher rate of growth. Then both the deputy governors have mentioned about the need for how does our banking system look like. Right now, it looks that we have a major, still dominant public sector, about, I think it would be still 55 to 60%. We have private, we have a small finance bank, we have cooperative banks, we have regional rural banks. So there is a time definitely for this committee to look that, is it helping or is it not helping? To me, small finance bank, regional rural bank, a lot of overlap. And the idea about RRB that they will be low cost, it all disappeared with the pay parity. This is high time to look at. The second is about, after 2008, globally, what I have observed, and I sit on the board of HSBC also, nobody believes big is beautiful or we need to be international. You look Citibank, what have they done? You look HSBC, what they have done. So they have exited left, right, and center from many markets. So there is a huge difference. When they decide to exit, they exit. But for Indian banks, that is not the route. If you're there, you can't exit. So you can't really manage your capital efficiency or return on capital in a very professional manner. So we have to very carefully examine that government, should they go for merger route, which has its own challenges and complications, although we have done successfully in the past, or whether it divests. So the second one is, we know political what to do, but still when committee is there, they can examine, and after that they can give pros and cons of both the options. And then ultimately it becomes for the political leadership to take a call. Then Mr. Viswanathan mentioned about directed lending and financial inclusion. So we have made a lot of progress, and here the role of the government banks, that comes to the problem. but now having achieved a certain level. So how do we encourage the private sector to be an equal participant? In general account, why does that 25-30 crore account have to be State Bank of India? So why? Because I am taking indirect cost, or I am able to absorb, and government's argument is also valid. I am providing the capital, I am telling you to do this, but this will not work with private sector. So how do we incentivize them to do this work? So we have to think about that if really we want more participants for financial inclusion, should we leave it entirely to the public sector banks, or why and what will make the private sector banks to take it in a problem? Then one issue, I don't know, but internationalization of rupee is a big subject, and capital account conversion. Should this committee not be looking at least this aspect? Even Nasiban committee looked at it, and capital account convertibility recommendations, the country was not ready to implement. But now in 2026, and with vision of having rupee as an international currency, another spanner which is coming in digital currency. So this issue of convertibility, internationalization, and digital currency, maybe all in one. It needs a serious thought and look by this committee. We have already discussed infrastructure, climate finance. Then what happens to new age sectors like fintechs, agri, SME? We are having clean tech, hydrogen, solar. So how do we prioritize if the capital constraint is there, and banks obviously cannot do everything? So how do we prioritize? That would be one. And the digital, AI, and cybersecurity. So, and data protection, that would be another chapter. Rest is all about a very clear framework from RBI on licensing requirement. So today, one day you give to Emirates, NBD, that you come in an RBL and have 50%. On the other, your voting right is 15%. So there's no clarity. Either the policy is case to case, or there is a policy framework. So that also probably ownership requires. So if I were to summarize, how would our economy would look like in terms of sectors in next 5, 10, and 15 years? We will have to divide. We can't say in 26 we are here and 47 we will be there, and there is nothing in between. So we will have to, because it will develop. New trends will come up. Second is the shape of the banking, how much now public doing, private, RRB, what is their market share, and what value add they are doing to the economy. Third is flow of international capital, and what role our banks play. And the other, of course, is large versus medium versus niche, and divestment versus merger.
Yeah, I mean, a lot of, as we started the topic, a lot of areas, sorry, to be covered. Sorry, at the end, you also mentioned about the clear policy on licensing. I would bring Mr. Sabharwal on this topic, because while we talk about banking as a part of, I mean, the committee's purview, I think NBFCs have also become equally or as important member of the financing ecosystem. So from an NBFC perspective, what are some of the factors which you think should be part of the committee's consideration?
I think this is a very wide topic, which will have a lot of points. To the earlier point, I feel India definitely needs more banks as well as large banks. If initially, if you remember, you spoke about the economy growing about 8 times over the next 22 years. If the economy is going to grow 8 times, I'm sure the credit will need to grow 12 to 14 times. And if it has to grow at that pace, and you do a reverse calculation, that as banks become large, the growth rate only becomes small, which is correct also. You've seen the largest private sector bank growing from 25 at growth rates of 25 earlier to 20, and now to more closer to 15 or to 12%. So growth rates will come down. So if you have to meet the needs of the economy and plan for that, I think we will need new bank creation, large bank creation every 3 to 5 years. Then only we can reach that stage. Otherwise, we will not reach that stage. Now, whether they will come as new entities, which looks unlikely, or some non-banks becoming banks, then I think time will tell, and the regulations will tell how it will shape up. And I think the regulator is the best person to decide how it should shape up. But what we definitely know is that we will need more banks and we will need large banks also. That is necessary if we have to meet the needs of the country. I think from just while the committee looks at it, what will be very important, whether from a bank or a non-bank perspective, to look at is how do we ensure there is enough liabilities available in the system. I'm less worried about capital, because if the institutions perform well, there will be enough capital available to support them. Whether it is domestic or international capital, there'll be enough capital as long as the entities continue to do well. Yes, it is going to be an issue for public sector banks, whether how much ownership can come into public, but capital will be available. I think more is about how do we ensure that enough liabilities are available and enough liquidity stays in the system. I think that is going to be a bigger focus as we move forward into the system. And the third thing, which also stems from what Mr. Vishwanathan said, is whether you call it risk or you call it whatever, finally it is governance. How do we make governance as a much stronger structural, while the regulator has taken a lot of steps, whether it is in terms of CRO role, compliance role, independence of those roles. But I think as we look to the future, a lot more probably can be thought through on making governance better, such that in case there are any problems which happen to any banks or non-banks, they are detected far, far earlier rather than they reach a stage when we need to do a merger or do something about it. So the other thing which we will all need to remember, at least I personally feel, that we are seeing probably the biggest shift technology can have, or impact technology can have in the whole system. And it, with Gen AI coming in, it will be transformative. If that's a low ball word, I would say, it will be far, far more disruptive than any of us are thinking today. And we need to be prepared for it and to handle it in all ways. And we have to find a way that we handle it the right way rather than the wrong way. So I think these are all things which we need to look together. Obviously, I don't know whether this committee will also look at non-banks or not, but I wish they do, and they lay down the path for how non-banks will grow, and also what will be the future when they will become large. And we need to think about it now rather than later, because we've seen the challenges of later, because HDFC did it later with HDFC Bank, which impacted the growth of the largest bank for a few years. So the impact is much larger if you do it later than earlier. So I think policy should look at it. These are just my thoughts. I just thought I'll place them.
Thank you. Thank
Can I
you.
make one or two points more quickly, very quickly, because
Please come in. Please come in.
Yeah. So one is this securitization market and development of marketplace for the loans. Some work was done by IBA, and RBI also gave its guidance and all that, but that is really not taken off. So that is another one thing. And talent management, corporate governance and talent management gels in that. How do we do the talent management, particularly in the public sector banks? So that would be probably another area for the committee to look at, but that means that the wish list is very long. So you may have to prune it, you may have to expand it, I don't know.
Since Rajnish said, I just want one line to add, Manoj, which is that, Mr. Rajesh talked of the resolution issue and did not deliberately bring it. But I think we have the FRDI bill. We must look at why it did not take off. Whether it's becoming a resolution for the entire finance system is causing a problem. Okay, having it with another institution rather than the regulator himself is another problem. I think we need to look at that. We have a bill. Some thoughts have gone into it. How to make it? We need a much better resolution process than we have today. But I think there are serious issues with FRDA bill. I was saying that when it was RBI, but then I was stakeholder today. I can tell even with independence that bill has a lot more of problems than it's trying to solve.
Actually, one more point. Yes, what Mr. Sabharwal mentioned about NBFC, I think I would say that also should be part of the wish list for the committee. In fact, I would put it as that, because consolidation in the NBFC sector is critical. You have 8,800, 8,900 small NBFCs. It's a very large number, but very small entity. So some kind of a consolidation path for them. What is the way forward for these entities? What will be the role of private credit in the times to come? Maybe even look at urban cooperative banks. So I think the committee could look holistically at the financial services sector rather than just only the banking sector.
Banking sector, correct. Yeah. So lot of discussion points, lot of areas, because this I think is one of the major impactful announcement of this budget, which can have a long-term strategic outcome for the country. Moving forward, I think the last topic of discussion for today is on vision of NBFCs for Viksit Bharat. There has been an outline for that. Clear targets were given on disbursement, technology adoption, etc. We also felt that in another 5 to 7 years, 50% of the credit to private institutions probably would come from NBFCs. So one is to improve the efficiency and scale. So in private sector, the announcement is that there should be a restructure the Power Finance Corporation and REC, which are the twins which are there. So I think some steps have been already being taken by the respective institutions in this regard. I would request Parvinder ma'am to come in at this stage. What are the steps which we are looking forward? What could be the synergies which we will emanate from this restructuring or amalgamation? Whether the combined entity can have much more strength, more products, etc. Your initial thoughts on this, ma'am?
I think if we see the financing for the infrastructure sector over a period of time, share of NBFCs have grown drastically. So if I can share with you the RBI report for 31st of March 2025, its infrastructure financing by NBFC is around 58%. And again, if we see that out of which around 4% is through private and private sector NBFCs, and the major is from the government-owned NBFCs. So this announcement is a welcome steps in the sense that when we talk of the infrastructure finance NBFCs, looking at the overall requirement of the funding for the infrastructure sector, which in one of the document as has been shared is around 900 crores by 2047, 900 lakh crore by 2047, of which the major portion is coming from the power sector. I talk about the power sector, we are looking at around 50 lakh crore by 2030-32, and again around more than 200 crore by 2047. PFC and REC has been both in the power sector financial and the sector specific NBFC. In order to have economies of scale and the benefits from the capital point of view, I think the decision is a very welcome step for the restructuring of both PFC and REC. And as you said, that institutions have taken certain steps, both the organizations and their board have decided that the both the companies may merge to emerge as a largest NBFC of the country. We were already having, this was a basically, I would say, a easier step for PFC REC to be undertaken because we are in the same sector. We are under the same administrative ministry and we were in the holding and the subsidiary structure. So on the overall basis, to have a larger capital base for giving an early financial closure and especially to expertise, I think a lot of, in the earlier discussions, lot of issues have been raised on the appraisal part. And being the sector specific companies, we have a focused approach on the power sector and working together for taking the government vision ahead. So I think that is the basic premise. And when you talk of the synergies, we will have, even if now we have a lot of commonalities, as I already described. So we will have a common appraisal framework. We will be looking at the overall requirement and especially the new sectors. When we talk of the green hydrogen, CCUS, small modular reactors, storage. So 1800 gigawatt of the non-fossil fuel capacity we are looking. So that is going to our combined tier 1 capital, which will be more than 1.5 lakh crore, will give us the, I think, enabler for funding of that requirement.
Thank you, ma'am, for those initial thoughts. And the merger is, both the boards have approved the way forward. At the same time, I would request Rajneesh ji to come in. I mean, as experienced person in this particular area, handling a complex merger, what would be the 2-3 key risks or challenges that the management of these organizations should ensure that they don't fall prey to?
So I think on the top should see people integration. That is always the biggest challenge in any merger. But as Madam mentioned that they were under the same mandate and already subsidiaries there. But still, like when the merger actually happens, situation may be different in case of PFC REC, but it becomes a host-guest relationship. We merged 6 banks in one go. So there were a lot of apprehensions amongst the subsidiaries, the people. मेरे ट्रांसफर का क्या होगा, मेरे पोस्टिंग का क्या होगा, मुझे क्या असाइनमेंट मिलेगा, मेरा फिटमेंट का क्या होगा, वेयर विल आई से, अभी करंटली आई एम जनरल मैनेजर स्टेट बैंक में मर्ज होऊंगा, मैं डीजीएम बन जाऊंगा. So people issue that can derail the merger, and IDBI and IDBI Bank is the best example of that, how merger on Air India and Indian Airlines, how these mergers were not successful because of the cultural and people issues. So that should receive the priority. And here the host means PFC will have to have larger herd to show towards REC people probably who will be more apprehensive because they are losing their identity. So that is one. Second is, of course, process gap, process analysis in both the organization in terms of that how do they come at par and standardize. Every process they will have to look at. Then third is, of course, technology. I don't know whether they run on different platforms or is it the same platform. So tech and data merger. So that will take some time and very careful planning so that there are no gaps left there. So sometimes there's a huge gap. Even again, coming back from my example, that we were on the same system, but the SBI system was much more advanced than what we could achieve in our subsidiary. So it was not, it was same, but not exactly the same. And item to item, it took almost 6 to 8 months of planning to identify that where are the version gaps of all the software which was being used, and then how do we bring it par. Then the balance sheet merger I always consider to be an easier part. not a complicated one. Board merger also probably will go through, but I would put it people on the top and then tech and data merger and the process standardization. Things maybe would be much easier for PFC REC. Then you can understand for State Bank we closed down 2,000 branches in 3 months without creating any political storm. So it required a much more detailed and granular level of planning. In this case, it may not be there, but these are some of the things which I thought that I should share.
Thank you, sir. I mean, I think you have brought it very basic requirements, which sometimes gets missed out in the consolidation processes that needs to be taken care. Also, I mean, this entity, as ma'am said, would be one of the largest, I mean, it will be the largest NBFC in the country. So while it creates a lot of capacities, it also brings in its element of risks. So from that perspective, I would request Rajeshwarji to put in his thoughts. What could be some of the risk management measures also that this entity, the new entity, should look into because of the size, scale, especially on a concentrated infrastructure space that they will be playing out?
No, I think that's a fair call. The concern is largely on the risks. And here I think the biggest risk will be the concentration risk. All your eggs are virtually in one basket, so to say. So what kind of diversification the NBFC would need in the times to come so that it doesn't become too concentrated? Because if anything happens in the power sector, then the entire risks spill back into the PFC and then it will thereafter spill back into the banking system, because the large proportion of the funding does take place either through bonds, investments, or through bank credit to many of these entities. So I think concentration risk and diversification could be some of the key challenges which the merged entity will have to tackle in the times to come. And maybe the regulator also will have to work closely with the entity concerned.
Thank you, sir. Thank you. So I think with these 4 topics discussed, we have fairly covered the areas assigned to us. I mean, there are participants in this webinar. I would request 1 or 2 of them to quickly give their thoughts, a 1 or 2 minute intervention. I would request Executive Director, Bank of India, Sri Rajiv Mishra, to come in.
If you allow me, I would like to respond to the risks.
Please, ma'am. Yeah. After your, please go ahead.
Yeah, I think it has been rightly put from the perspective of what are going to be the challenges for the merged entity. If we talk, manpower is always said to be the larger risk, but we have both of organizations have a very lean manpower, and we are concentrated at one place. Our operations are majorly from one place. We don't have the challenge which generally the banks have with lots of branches and lot of, I think, geographical spread. On the other side, there are, especially on the manpower side, our policies are aligned, and the scales which are there, which has also been aligned. So on that front, we will also not be facing much of the challenge. I agree that there could be with regard to the technology and the technological platforms. Right now, both are on the same platform, and gradually we will be upgrading definitely with the merged entity. So those challenges have also been analyzed. But yes, when we do actually, then only we will be knowing that what are the challenges that is going to be there. Yes, cultures may be different. When you work in a particular organization, then you are adopted to a particular culture, and when the merged entity is there, then both the companies need to align their culture, and gradually it may take some time. On the risk front, I think it has been thought well in advance, and in 2023, both the organizations were allowed to diversify from the power sector, even though to a limited extent. So we have been already given the mandate to diversify to the other infrastructure sector as per the harmonized list, but with a special focus on the power sector, looking at the overall requirement of the power sector. And definitely we will be looking ahead at how this merger and the merged entity comes up. And definitely we would be having the guidance from the regulator in this regard. Thank you.
Thank you, ma'am. Rajiv ji, you can come in now, please.
Thank you, sir. Good afternoon to all. And it was a pleasure to be hearing all the esteemed panelists here and lot of learning experience, sir. In fact, it was very well pointed out here that the days to come, when we look at it, the need of Viksit Bharat to go from 4 trillion GDP to the 30 trillion GDP, we need to have a lot of changes. And the bank landing, the landscape changing from the lending landscape to the liability, availability of liabilities, to the role of the banker to be a banker to every citizen of the country, or we can say financial inclusion 2.0, to the change in the technological landscape requirement where the AI, genetic AI is coming, the requirement of the talent manpower, which is required both on the skill sets, which are required both from the IT front and the other on operational front, including the risk. We need to change the entire gamut of it. We are looking at funding the sunrise sectors, which would be the sectors or infrastructure sector, which was discussed in the first point of discussion, which would be the actual growth propelling to us to see that we reach that higher trajectory. But then that will also require a higher capital requirement for the bank. So looking at on that thing, the term of reference and which was writing out, if we want to do all those changes, there has to be good corporate governance which needs to be followed on. So my take is that we need to form of all these things and look at it, how we want to do it. And finally, when we look at the merger part of it, Rajni sir very rightly pointed out, with the size of the banks which we are, we need to look at all those 4 or 5 areas, people, process, technology, to be put in place. So it's a well thought of discussion here, sir. Thank you for making it part of it. I think we are going in the right direction here.
Thanks, Rajiv ji. I would now request Ashok Chandra ji, MD and CEO, Punjab National Bank, to come in.
Good afternoon to all of you. I think it was a really very great pleasure in understanding, listening to all of you. I think all the esteemed panel members. A lot of takeaways are there from this entire discussion. I will be restricting to some of the discussions which has already happened on that important thing which I would like to flag it here. I think the government is spending 10 to 11 lakh public capital expenditure every year for the last few years. And this year also, 12.2 lakh crore of public expenditure has been planned. Rajnish sir rightly mentioned that the private capex, which is expected to come, and in fact, that should drive the expenditure and that should drive the economy. I think that is little bit is missing in the entire economy. And he very well suggested that whether the clouding of investment in some sectors, that should happen. And I can share my experience, what is happening in the entire banking system for the last 1 or 2 years. I think there are some sectors, they are behaving very well, where we don't see any risk also. And there are interest from the private sector enterprises. Those sectors are like renewable energy, battery storage devices, defense sector. I think we are seeing a lot of interest and people are coming forward. Roads and power sector, that is behaving very well and a lot of interests are there. Renewable energy, I think that plays very important role from the point of view of the projected 500 gigawatt which India has signed by 2030 going to happen. And current capacity is only 285 gigawatt. So a lot of opportunities are there. And since this particular sector is also behaving well, I think we see a lot of opportunities going forward. And definitely the private capex should fill those gaps which is there in this particular activity. So these are the 6 sectors where I feel that clouding of private investments, definitely it should happen. And if we are all aiming for the 2047 Viksit Bharat, I think these 6 sectors going to play very important role. Now, coming to how the funding has to happen, I think some discussions have happened about the bond market and especially the corporate bond market. There, my take will be that we need to deepen this corporate bond market. And for Viksit Bharat, we require $30 trillion and the per capital income also it is required 18,000 USD. So that requires a very large scale long-term capital. Currently, when I was just seeing the figure, the market cap of equity in India, that is $4.8 trillion. But the bond market, if you see that what is the market cap of that is, it is hardly 0.64 trillion USD is there. So I think there the big opportunities are there, and definitely I will suggest that whether the corporate bond market, municipal bond market, I think Kiran Raj sir also mentioned, and the deputy governors also mentioned, Rajeshwar Rao sir and Vishwanathan sir. I think municipal bond market, green markets, and green bonds, I think those things I feel that should be encouraged. And the sustainable infrastructure growth, I think definitely bond market has to be penetrated, and it has to play very, very important role. I was just seeing that the one thought is that investment grade instruments, that also should be allowed in the bond market with fiscal responsibility and budget management, that FRBM framework. I think all states should be allowed to participate in the municipal corporations. They should participate in the bond market, and all state entities to raise funds through this bond market only. I think this is one some sort of directions, or some if it is required to be made through the act, I think that also should be done. Secondary market to be made very vibrant, and our present turnover, which is just 0.3, whereas in China or other developed countries, China it is 1.6, and Indonesia I was seeing it was 1.17. So I think that market also has to be very, very vibrant if we want to see that the entire ecosystem has to go to a different level. Maybe the tax incentives can be allowed to from the income to be generated from these bonds and capital gains. Now, again, important aspect that is the pension fund. Their present AUM is around 16 lakh crore, and insurance fund having AUM of more than 75 lakh crore. I think that has to be encouraged, and it has to come in the bond market participation. And they need to play very, very important role. Along with this, whether we can come out with the MSME bond also to be introduced and to be kept at par with the corporate bond market in order to further support the MSME. I think these are some of my thoughts about the bond market penetration and the role which the bond market is going to play in the Indian economy. I think we have already seen that for in this budget, a lot of thrust has been given on the MSME financing, and all the CPSEs are now mandated to use the trade receivable, that is a trade platform. What I feel that a lot of awareness is required, because that trade market, trades are there for a long time, and RBI had pushed it, and it has brought some vibration in the economy. But the opportunity which is there in the entire ecosystem, I think we need to further escalate and further penetrate in the market with the budget enablement for the CPSEs. I think definitely this particular market will behave very well. REIT financing proposed by the budget is a welcome step, and all the banks, they will be taking up a good exposure in this particular field. Last point is the initiative of the government to set up high-level committee for banking reforms. I think definitely they are going to look into all those aspects related with not only the banking reforms for the entire financial sector ecosystem, and definitely outcome will strengthen and will provide the roadmap for the Viksit Bharat 2047. So thank you very much, and I'm very thankful to the DFS for giving me the opportunity to participate in this discussion now. Thank you.
Thank you, Chandraji. You kind of summarized the topics which we already discussed. I would also request Mr. Bhaskar Babu to come in to give the perspectives of SFBs in this whole journey towards Viksit Bharat 2047.
Thank you, sir. It was a great learning from the panelists. Sir, I'll stick to very short and purely on financial inclusion. Sir, there is a complete rethink probably is required on inclusion. It started as more of poor, rural, as an obligation for PSL. Probably things have changed. It is not just one segment. It is no more just about including who have been excluded earlier. It is also about in terms of catering to substantially aspirational segment. As we talk about more on technology, AI and all of that, the biggest risk probably in this segment, which is probably 20 crore households of the 50 crore households, is staying relevant. And for staying relevant, it is not just enough to just tick the box in terms of inclusion. It, as Prime Minister also mentioned, from intent to delivery experience, this can happen only when there is a complete harmonization between products and how it gets delivered to them. In a world where we talk about technology, we still insist on passbook being printed in the branches, where UPI transactions will run into tens in a day. So there is a complete rethink which is required as part of this, and probably this high-powered committee meaningfully spending, starting with even the way in which inclusion is defined and how it can be delivered, will be a very, very useful approach. Sir. These are 3 bits from me. Thank you.
Thank you, Bhaskar Babuji. I mean, a very good point which you brought out. I mean, we have, how do we go beyond the numbers in terms of financial inclusion, and how can some new parameters and metrics which actually say what financial inclusion involves can be brought in, which suits, of course, numbers were suited at certain point of time. Going forward, now we have achieved the numbers, how those numbers can actually translate into real financial progress to the members of this society. So, I mean, so we are kind of reaching the end of the discussion points. So I would now request Professor Charan Singh ji, eminent economist, and our valued professor, to come in and provide his final comments, a summary of the discussions what we had today.
For this opportunity. I think we have had an excellent discussion for nearly 2 hours now on 4 different aspects. We started with the story on the CapEx, and I think many issues that came up are worthy of discussion. And in the summary, I would simply like to say that there is a scope of many more projects to be identified, as mentioned by one of the panelists. Probably have a bank of projects, identify districts, maybe aspirational, and see if those can be opened up to the private sector to come and play a role there. One important issue that came up, and I think that's very relevant, was brought in by the panelists from the SBI. The point that in the past, disproportionate risks had been passed to the private sector. They've burned their finger. Now the trust needs to be built in to bring them back. How to bring them back? The point again was made that there has to be return on capital. That's the prime objective of the private sector. The development financial institutions play an important role, and in the long term financing, they are the most important as a financing unit. The point that was made there, I think, is very important. States need to also be taken into confidence and carried along. The 2 illustrations that came on the climate and land issue, 2 factors that need to be taken into consideration while the formulation of the plan is being done at the initial stage itself. Municipal bonds have been coming in various discussions throughout the day today. And I think that's very important that also in the private sector can play a role. There are new areas which are emerging, green energy, data center, and that probably would attract the private sector to bring in capital. One point that was made, and I think is very important, that new sectors, new technologies need to be thought about. From the power sector, the point was very well made that the power sector has stabilized. Lots of capital is already flowing in, especially for the renewable sector. One aspect that emerged from this discussion, and I thought was a very relevant point, was we need a good study as to why the private sector is shy. Is it that after a certain threshold level, and that's my thought, the private sector would come in very quickly? Is it while most of the capital investment by the government is being done in point to point, and in between there are cities and towns which are feeling left out, and private sector doesn't see it as an avenue, and therefore after a certain threshold they will start investing? Is there some incentive that we are missing that can become part of this study? It was mentioned that asset light investment is probably playing a role. And also, and maybe, that trading has become more profitable than manufacturing. The second section of this discussion was on the guarantee fund. And I thought that was a very interesting area. Is it we need help in financing projects, or is it cost? And there was a thought on both the aspects. Maybe it is both. Well, one thing was very clear, that this is a complex issue. How do we reduce risks? Should there be a separate body? How should we go for risk appraisal? Should it be done by the lender itself? Should merchant bankers have a skin in the game? What would the cost of intermediation? We also thought about, should there be a regulatory relief provided? Again, a very good example was hydro projects suffering from climate risk. Can this fund help? Urban infrastructure, urban bodies may need to have some support, and this fund may be of big help there. Another thought that came in was the fund may be there to sort of mitigate the risk or provide the initial support, but maybe we'll need liquidity fund also. Redressal mechanism has also to be addressed. Dispute resolutions have to be seen, because while you're doing an assessment for a long-term infrastructure project at the initial stages, you might not know the things that will turn up as times pass. And therefore, mid-term review, maybe monitoring will have to be done. One issue that came up here, and I thought that was very good, was there may be strategic sectors in the budget that may benefit immensely from these guarantee funds. Maybe one should explore that they can serve as a catalyst for emerging sectors to take off. In nutshell, the panel thought there is a need for an internal group to study various aspects of the guarantee fund and its implementation. The third issue, which is very dear to my mind, part of the Viksit Bharat, is how about the high-level banking committee? On this, various aspects were discussed in terms of the terms of reference for the high-level committee. Is there a need right now after the two Narsimham committees? I think yes, and that is the broad feeling I got from the panel. What should be the structure of the economy that would have to be funded from a 3.5 trillion to about a $35 trillion economy? What will be the agriculture industry services like? Would we need a brick and mortar branch, or should we go digital? What should be the structure of the banking sector? Should we only focus on the banks and focus on the public sector banks? Or would it be now time to even focus on the private sector banks? Should the non-banking finance companies, which have played a very important role, the shadow banks in the Western world, be relegated on the side ring? Or should it become an integral part of the main study by this future-looking, forward-looking high-level committee? Should we restrict ourselves only to the NBFCs from the banks, or should we also include other financial institutions like the urban cooperative banks that are now very well regulated by the Reserve Bank of India? I think the thought procedure that happened in this panel discussion was very rich. The panel also thought, in future, what will be the economy like? We will have to focus on digital, we'll have to focus on data. Therefore, we might have to bring in the issues of globalization, like internationalization of the rupee, which was put on the side ring in the earlier committees, but Tarapur committee spoke about it at length. We almost concluded, whatever said and done, we will have to take care of the governance issues. Finally, the issue came on the government's power sector NBFC. And I think there, the issues were quite clear. The path on consolidation has started. Diversification between the two is already done. The thought on the HR issues has already been playing a role. What should be the merger like? What are the issues that will have to be focused on? Technology could be one. Balance sheet, of course, is not a major issue, but data merger could be another. So I think all in all, the panelists have contributed significantly to the exercise which the Prime Minister was saying, that we need to brainstorm on issues that have been mentioned in the budget. Thank you very much.
Thank you, Charan Singh ji. I think we have reached the end of the breakout session which we had. And I'm sure we had a wonderful, wonderful deliberations. Thanks to all the panelists and participants, especially for Professor Charan Singh to summarize the entire discussion in such a concise and wonderful manner. And I thank all panel members once again and all the participants for their active contribution. Thank you very much.
Thank you.
Thank you so much.